I think we're still in a bull market. You've never been late cycle in the stock market when the ISM is below 50. In fact, you've always been mid-cycle, early cycle. So it's actually a very bullish sign that the ISM is still below 50. Let's think about the next 10 to 15 years. Wall Street's going to build a market for digital assets. Now, for reasons I won't cover here, it's going to be on Ethereum because that's really where everyone is building this future. But the thing I want to highlight today is that Wall Street is going to build a market for digital assets onto the blockchain. So it's more than just dollars, it's everything. So think about this. There's two story arcs that are going to be the next 10 to 15 years why I think it's the biggest macro trade.
Tom Lee says we're at the start of the next great transformation. Just like the dollar went synthetic 50 years ago, everything else is now going synthetic, from assets and data to identity and reputation. The U.S. Congress has already passed the Genius Act, laying the legal foundation for a stablecoin boom, digital dollars on the blockchain. Meanwhile, the SEC's Project Crypto is encouraging Wall Street to move its infrastructure onto blockchain networks.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
In 1971, the dollar became synthetic. Now, you may not know what I'm talking about, but in 1971, the dollar was no longer convertible into gold, which means the dollar became a synthetic instrument because you could only exchange it for $1. Now think about what that means. In 1971, a lot of folks got scared and they said, well, I want to buy gold instead. And actually that was a great investment. But if everyone bought gold, the US economy would have collapsed, right? Because the dollar represented nothing but itself. So you had to create a system where people would believe the dollar was useful, and that was what Wall Street did. They created all these financial products because the dollar became synthetic. Money market funds in 1971, currency futures in 72, debit cards in 78, mortgage-backed securities, currency swaps, interest rate swaps, S&P futures, zero coupon bonds. I mean, a lot of these you guys all remember, exchange-traded funds. If Wall Street didn't do that, another currency would have become dominant. But that's not what happened, right? The dollar today is 80% of all financial transaction quoted pairs. So when we went to a gold, off the gold standard, the dollar became the dominant pair. And in fact, 7 of the top 30 largest companies in the world are banks, including JP Morgan, Visa, MasterCard, B of A, etc. Okay, well, in 2025, which is 2 generations later, it's not just the dollar that's becoming synthetic. Everything is going to become synthetic. Let me explain that. The first is the Genius Act, which is what Congress passed earlier this year, which creates the stage for a stablecoin boom. And then the SEC announced Project Crypto, which is encouraging Wall Street to move on to the blockchain. Remember, the blockchain is a public software, basically gigantic public software, but what it does is it verifies transactions and it stores records and information, and it eliminates a lot of the cost and friction that Wall Street experiences today. In fact, Treasury Secretary Bessent believes that just the stablecoin market could be $3.7 trillion compared to $250 billion today. That's exponential growth as we start to see Wall Street move things synthetically onto the blockchain. So what does that mean? Well, if everything's becoming digital, okay, you've heard a lot of people say, well, you want to find the digital store of value, the digital gold, which is Bitcoin. And that makes a lot of sense. That's what Fundstrat has been advocating for since 2017. That was more than 8 years ago. And in fact, Tireless Ken remembers When we first started writing about Bitcoin in 2017 and we said it would be institutionally adopted as digital gold, people ridiculed us. We lost a lot of customers actually because they thought we really lost our grounding to reality. But as you know, 8 years later, that's the narrative. Bitcoin is digital gold. Well, let's think about the next 10 to 15 years. Wall Street's going to build a market for digital assets. Now, for reasons I won't cover here, it's going to be on Ethereum because that's really where everyone is building this future. But the thing I want to highlight today is that Wall Street is going to build a market for digital assets onto the blockchain. So it's more than just dollars, it's everything. So think about this. There's two story arcs that are going to be the next 10 to 15 years why I think it's the biggest macro trade. The first is stablecoins, the upward one. Stablecoins, we're going to tokenize stocks. NASDAQ actually just approved that this week. We're going to tokenize credit, tokenize real estate. Maybe we'll monetize our reputations on the blockchain so we can value that. And we'll monetize intellectual property, which, as you know, is the largest component of CapEx today. So if you look at GDP data from BEA and you look at what they call private investment spending, the largest share of that is intellectual property. That is easily moved onto the blockchain. But then there's another story arc. If you're going to be able to digitize that information, you're going to monetize data collection, royalty streams, loyalty programs. As you know, that's a huge business, is the value of your frequent flyer miles. Then there's going to be agentic AI and things like proof of humanity. So that all is what you're going to see in the next 10 to 15 years. This is the biggest opportunity for Wall Street ever. I think we're still in a bull market, and I think it is about U.S. leadership versus the rest of the world. I think it's going to be clear as I walk you through the reasons for that. And the first place to start is why I think the investment outlook is better now than it was at the start of the year. So the S&P's up 10% year to date. You can see that huge dip that started in February, was a waterfall decline in April. I think a lot of people panicked and unfortunately sold at the bottom. But we had advised folks that when you see waterfall declines, as long as you don't have a recession, markets will stage a reciprocal recovery, which is in fact what happened. So think of that decline, which in a way was a bear market because it reset positioning, and now we're in a new bull market, but that was actually a very predictable recovery. And so if you ask me where I think we are by the end of the year, I do think it's a strong fourth quarter. So I think the S&P gets us to 68, 6,900, possibly higher. Mark Newton does think, again, similarly, that we're going to have a big fourth quarter. And there's a couple reasons for that. One, corporate profits are strong. Household balance sheets are still strong. We've got a lot of AI visibility. Something to think about, many people don't, is the financial sector is about to have some pretty big productivity gains coming the next 3 to 5 years. And I'm going to cover that in this presentation. And the Fed is going to cut rates. Okay. So let's start with the ISM. The ISM is still below 50. It's at 48.7. If you're not familiar with it, it is the most widely used measure of manufacturing confidence. And it's 31 months now below 50. That is the longest stretch in the history of the index itself. And as we point out here, you've never been late cycle in the stock market when the ISM is below 50. In fact, you've always been mid-cycle, early cycle. So it's actually a very bullish sign that the ISM is still below 50.
Why Tom Lee is bullish. After laying out the structural megatrends, Tom Lee turns to the current stock market. Despite constant fear and skepticism, he says the S&P 500 is up about 10% year-to-date, and the pattern of price action suggests a new bull market began after the sharp decline in April. That drop, what he calls a waterfall decline, scared investors into selling at the bottom. But Fundstrat's view was clear. As long as there's no recession, waterfall declines are followed by reciprocal recoveries, and that's exactly what happened. Lee believes the fourth quarter will be strong, with the S&P potentially reaching 6,800 to 6,900 or higher by year-end.
Okay, so that gets me to the last point, and I believe there'll be time for questions too, which is, I've given you 5 reasons to be bullish on stocks, but yet this is the most hated rally ever. And I believe I know the reason. I'm going to explain it, but don't get angry at me if that's the reason, okay? First, it is, in our view, the most hated V-shaped rally because at Fundstrat, we survey people, we ask them how they're positioned, what they think of multiples. This is not, we get cautious sentiment and skepticism. That's not what you expect at the top, and that's healthy. If people are skeptical at the top, that means there's still plenty of room for stocks to go up. And we can see it numerically. I like this survey. This is the AAII Bulls less Bears. It's currently negative 10.7. That means there's more bearish people than bullish people. And in fact, for the last 5 weeks, as the market's made all-time highs, the net bulls is bearish. Do you see it? Minus 11. We've had 5 weeks while the market's made all-time highs and everyone's skeptical. In fact, this is from Tireless Ken, you looked at all the times the market had a 25% or more rally, and I put a red dot. Usually sentiment's quite bullish by the time you had a 30% rally. We've had a 34% rally, and yet the average sentiment is still negative. That tells me, first of all, that most people went to cash in April. They didn't think we'd recover, and I don't blame you because I remembered at the April lows, we heard a lot of people tell us, Tom, there's no way we can recover because the Fed's not going to cut rates or expand the balance sheet, so you don't have any liquidity coming. Our argument was that waterfall declines always see reciprocal recoveries.
Lee addresses something fascinating and deeply psychological. Despite the market's strength, this is the most hated rally in modern history. Fundstrat surveys show persistent caution among investors. Even as stocks hit all-time highs, sentiment remains negative, with more bears than bulls for 5 straight weeks. That's unusual. Historically, after a 25% or greater rally, sentiment turns highly bullish. But today, after a 34% rally, investors are still skeptical. Lee interprets this as extremely bullish. It means most people are underinvested. They sold during April's panic and stayed in cash, assuming the recovery wouldn't last.